Real estate versus stocks. Which one actually builds wealth faster? They say that real estate is one of the greatest ways to build wealth because it has stood the test of time. While that's true, it's not the whole story. If you're looking for fast wealth creation, there are other assets that can get you there faster than real estate. So in this video, we're going to be comparing real estate versus stocks to see which one actually builds wealth faster. Hey guys, what's up? It's me here. Real estate versus stocks? Which one actually builds wealth faster? When it comes to building wealth, the old adage of buy real estate, they don't make them anymore, has been passed around for decades, if not centuries. And for the most part, it's true. It's unlike stocks, which can instantly drop by 30% in a matter of minutes. Real estate doesn't fluctuate in value based on market sentiment or monetary policy changes. In fact, housing prices tend to increase over time as demand continues to grow. But that's just half the story, because while it's true that real estate does appreciate in value long term, it doesn't mean that it's going to be the fastest way to build wealth. After all, when you buy a house, you have to spend a significant amount of money up front before you even see any return. And sometimes that could take years. However, stocks, on the other hand, are entirely different. You could invest $1,000 today and potentially turn it into $2,000 tomorrow, all without having to fix a leaky roof or deal with a difficult tenant. But which option is right for you? Well, let's talk about how each one works, the pros and the cons, and then most importantly, how much money you could make along the way. Alright, so first let's address the elephant in the room. Yes, technically real estate is a tangible asset that provides you a physical place to live, while stocks are just a piece of paper that represents a small ownership in a company. However, from an investment standpoint, both are simply a way to diversify your holdings and grow your wealth over time. Of course, the key difference is how much control you have over each one. For example, if you own stock in Apple, you have no say in how the company operates, or if they decide to manufacture the next iPhone in China instead of the United States. But when it comes to real estate, you have complete control over the property. You could renovate it, rent it out, or use it as a vacation home. All of that helps to increase its value over time. That leads us to our next point. Let's discuss the risks associated with each one. And after all, isn't the whole point of investing to mitigate risk by diversifying your portfolio? Well, first let's start with real estate. Real estate can be a great investment, but it's important to be aware of the potential risks involved. After all, it's a highly illiquid investment. This means that if you need to sell your house quickly, you might have to sell it at a discounted price. On top of that, if you purchase a property that needs repairs, unexpected costs can add up quickly and eat into your profits. For example, when my wife and I purchased our first triplex, we had planned to renovate one of the units each year. However, when we went to do the work ourselves, we found a lot more issues than expected, like faulty wiring, outdated plumbing, and a new roof. These were all unexpected costs that we did not account for in our initial budget. Because of this, I would always recommend purchasing a property that's move-in ready and leave all of the renovations for later. That way you avoid the stress of unexpected costs, and you have time to properly factor it into your overall expenses. And then when it comes to stocks, there's also a level of risk involved. Although historically the S&P 500 has returned around 10.5% since 1926, there's no guarantee that those same results will continue into the future. In fact, during 2022, the S&P 500 lost 18%, and certain companies were hit much harder than others. The best way to mitigate your risk with stocks is to follow the guild practice of buying and holding. By doing so, you'll be able to buy low and sell high, thus reducing the chances of selling at a loss. Now, of course, it's not always easy to stomach watching your portfolio drop in value. But historically, the market has always recovered, and you would have missed out on some pretty big gains if you sold at a low. Just think of all the people who sold their stocks during the March 2020 crash only to miss out on the biggest bull market in history. So when it comes to risk, I would argue that real estate tends to be less volatile, because housing prices change gradually over time compared to the roller coaster ride that is the stock market. However, it's also much harder to liquidate your investment if you need the money quickly. Okay, so now that we've discussed the risks of each one, let's talk about how much money you could actually make. And really, this is what it all boils down to. How much cash flow is generated from each one? Well, generally speaking, real estate is a relatively stable investment that can provide a steady stream of income. Rental properties, for example, can generate enough cash flow to cover the mortgage and other expenses, leaving you with extra money in your pocket each month. On top of that, the value of the property can appreciate over time, meaning that your investment can grow in value without you having to do anything. According to a recent study by Bigger Pockets, the average rental income in the United States is around $27,000 per year, with a median occupancy rate of 96.6%. In addition to that, it was found that the average annual appreciation rate for single-family homes is 4.4%, while multifamily homes appreciate at a higher rate of 5.7% annually. On the other hand, stocks have the potential to offer higher returns. Historically, the stock market has averaged an annual return of around 10.5% over long periods of time. But again, there's no guarantee that these rates will continue in the future. During 2022, for example, the stock market saw a downturn with certain growth stocks dropping by over 50%. Although the market has recovered, there's no telling when another crash might occur. If you want to maximize your chances of making the most money possible in the stock market, consider investing in an index fund. Index funds allow you to diversify your holdings across a wide range of stocks, which can help mitigate your risk while still earning a high return. A good example of this is VTI, which is an ETF that tracks the composition of the Wilshire 5000 Total Market Index. As of recording, this fund has an expense ratio of 0.03%, and over the last 5 years, it's returned 13.4% annually. Okay, so now that we've covered the basics of each one, let us talk about how each one compares in terms of cash flow and how long it takes to reach a profit. And this is really where things start to get interesting. Real estate is known as a slow and steady form of wealth generation. After all, you have to spend a significant amount of money up front before you ever see a return on your investment. For instance, if you were to buy a house for $300,000 and put 20% down, you would need $60,000 cash in savings, a low credit score, a steady income, and a solid credit history. Then once you've purchased the property, you have to spend even more money fixing it up before you can rent it out to a tenant. However, on the bright side, if you do everything right, you can eventually reach a point where the property generates enough income to cover the mortgage insurance, taxes, and all of the expenses, leaving you with extra money in your pocket every single month. From personal experience, I know that this can be a great source of passive income, but it does require a lot of work up front before you get there. Now, unlike real estate, stocks are a much more accessible investment. You could start investing with as little as $5, and it's relatively easy to set up an automatic investment plan that allows you to buy more shares over time. In terms of returns, stocks have the potential to offer higher returns than real estate. However, it's important to keep in mind that these returns are not guaranteed, and it's possible to lose money investing in stocks. But then finally, there's cryptocurrencies, which offer the potential for even higher returns than stocks. Crypto, however, is much more volatile and risky, so it's important to be aware of that before investing. So which one is right for you? Ultimately, the decision of whether to invest in real estate, stocks, or crypto depends on a variety of factors, such as your financial situation, investment goals, and risk tolerance. If you're looking for a more passive investment, real estate might be a good option for you. However, if you're looking for a more hands-off approach, stocks might be a better choice. Just remember that diversification is key. Spreading your investments across different asset classes can help mitigate your risk and potentially increase your returns. As for me, I personally prefer investing in stocks and ETFs because they allow me to diversify my holdings without having to manage a property. But that's just me. What about you? What's your experience with real estate versus stocks? Which one has worked best for you? Comment below. I'd love to hear your thoughts. Thank you guys so much for watching. As always, feel free to add me on social media. Enjoy. Thank you so much for watching, and until next time.